Alright, I think I'm live, but let me double check real quick. Okay, just give me a minute here. Yes, looks like it. Double check. Okay. Alright. Back live, you guys. I know, I've been live all day, I feel like. Today, I'm on the roll, you guys. Hold on, let me prepare real quick. So today, it's just going to be, I just want to put my thoughts out there, because tomorrow is a trading day, so people might, be distracted about the Christmas time, and they don't really, care about much about the economic and all that stuff, right? But today is my way of relaxing. This is how I relax, and when I relax, I tend to, kind of want to know a little bit more about the market, about what's going on in the stock market. But since I have the algorithm that relates to Gamestop, Sofi, because I've covered this topic before, a lot of video popped up on my feed, about YouTuber talking about Sofi's and all that stuff. Now, I know, there are a lot of positive sentiment about this company at a current time. I just think that there is a little bit unfounded, in my opinion. Obviously, I don't have any credential. Obviously, there's a lot more people like this guy who knows a lot more about this type of thing than me. But I think it's overhyped, in my opinion. Now, I'm going to show a snippet of this particular Oh, you're on. Lionel, hey, what's up? Okay, good. I sound different. What happened? Is it better? Anyway, yeah, my microphone is kind of far away from me, so that's why. Okay. Anyway, as I was saying, I just think that it's a little overhyped when it comes to Sofi. Now, at the current state, yes, there are positive sentiments out there that might be warranted that the price action is going to go up, substantially. I don't know what's substantial to you. To me, if it's 2x, 3x, or whatever, that's pretty substantial. But again, it's no guarantee of that. To me, the macroeconomic doesn't really support. I'll show you what I mean by that. But let's just listen in a snippet of this, and I'm gonna kind of speed him up a little bit here. Now, at the same time, I might compare this to GameStop, because I just feel like, anything that this guy is saying about SoFi, I think, GameStop could achieve even faster, in my opinion, right? At the current balance sheets, if you were to compare balance sheet to balance sheets. Now, I get it for SoFi supporter out there, or whoever, kind of bullish about this company. I realize that it's two different industry here. I'm not trying to compare that at all, but I'm saying that if you were to compare the balance sheets, SoFi balance sheets to GameStop balance sheet, I think GameStop is much closer to whatever people, much closer than SoFi could ever be, right? But again, the sentiment is out there. And I think I showed you guys this before, where even CNBC, is kind of like moving towards that sentiment as well. I think this is like a month ago. This particular lady here kind of pushed SoFi and saying that there might be an upside here, right? But that's neither here nor there. Up 90% in 2023, right there, why ARK could profit from buying more SoFi stock. So those type of articles coming up more. Now, in my opinion, I think this is, again, just one more stock to push in front of you to drive, retail away from GameStop, right? Now, to me, that's a good thing for long-term investor like you and I, who, believe in GameStop in the long run, right? Because the less people know about it at the current state, the better for investor out there. But you gotta take emotion out of it, right? In terms of the price point here, the price is going to be, price undervalued for a long time. Just like Ryan Kitty was saying, when GameStop was at $1 a share. At this current post-split, right? I'm comparing post-split, but at the time it was $4 a share, and it was at $4 a share for a long time, and at one point even dropped down to $3. So that is like depressing for people who were at that bottom, right? But if you were to look at the balance sheet, and that's what Ryan Kitty was able to look at, I think he looked at the cash flow, right? At the time, GameStop has a cash flow of $6 a share, in the positive, but it was trading at $4. So that's a classic misprice of either retail or, Wall Street out there. They didn't realize that there was that egregious, or that they miss pricing the company that badly, right? Or they did, but they just want people to misinterpret, the balance sheets due to whatever they're trying to present at the time, that physical media is gone, therefore GameStop is done, right? It's still prevalent until today, even though there's games that comes out with the physical disc right now as we speak, right? But anyway, so let me hi, Merry Christmas, Jay. Thank you for hanging out with me. I'm just talking about SoFi right here, but in comparison to GameStop too. But so let's listen in this gentleman right here. Now, I watch him, for the bond data, and he's pretty knowledgeable about all that stuff about, the bond market and what it does, the relationship between the bond and, the rate versus the value of the bond. So, but I think, about SoFi, I feel like it's a bit hyped up. But let's listen in real quick.
Do you want to learn how to make your money work for you in 2024 and stop slaving away for money? That's what the 99% do, whereas the 1% actually make them /webinar. We do a live trade. Now, 75% win ratio system. Okay. It's very, so very simple, and I give it to you. So come and join me. Now, the big juicy news about to happen as I'm recording this is SoFi will be profitable from the fourth quarter of 2023 onwards. That's the first quarter where they're really like gap profitable, real profit.
Okay, so let's mind you how much profitable is it? Well, this is just a hold on, let me show you. I think I showed you this already. Hold on. Try to spell sentiment here for some reason. So I think SoFi, right? So again, in comparison to GameStop, obviously, GameStop is due for a profitable quarter as well. But if you were to look at the estimate for SoFi right here, I kind of mark it already in my other live stream or my video as well covering this. Look at it. So the earnings that they're expecting them to be profitable is less than a cent. That's the estimate, right? So in my opinion, I feel like that's a low ball, right? It's almost like a setup for them to it's a low bar to climb for a company to, at the scale. I'm not saying like SoFi is not that big, But as far as like being the number one bank, quote unquote, I think they would blow past that at no time. And I think, there's a reason why the estimate is so low for SoFi here. Again, I don't know how they come up with this estimate sometimes, but if you look at GameStop though, the estimate is a lot higher. Even though they're saying that GameStop doesn't make any money, look at the estimate for GameStop, 27 cents. I'm not saying that GameStop doesn't beat that. I'm sure GameStop will exceed expectation in this particular quarter as well. But just the contrast here, it's a little bit frustrating to say the least, right? So again, this is why I have the opinion, again, this is just my opinion, that the media out there, including the analysts, including the people that give all of this, all of this sentiments or whatever, or the estimation, are doing a disservice to people by way of manipulating them, right, into thinking that, okay, SoFi is going to be better than GameStop or whatever, while it's not, it really is that way. Of course, the revenue is $2.2 billion estimate, while SoFi is $500 million. You see what I mean? So they would never give, GameStop that accolades ever on the media. Now, to me, that's a good thing, because when they're negative about something, that means that it's a good buy, right? They don't want people to buy it at this price point. So they would much rather you buy into SoFi, right? So at this moment in time, I'm not saying again, in 10, 15 years, I'm sure SoFi is going to do well, in the banking sector. But with that being said, though, it is at risk because of the current economic or macroeconomic here. Okay, this is my opinion here. So there you go. So let's continue on.
Profitability that would please Charlie Munger, rest his soul. And what I would expect is that in all quarters in 2024, we would expect to be profitable. Does that then bring S&P 500 inclusions on the horizon? Well, let's come back to that thought in a moment, but hold on to that.
Okay, so GameStop could do that too. So there you go.
Thoughts. It's an important one, and we'll walk through what the timeline might look like there. First of all, I want to run you through a little bit of what's expected and what SoFi needs to do to beat the expectations, and that's what a stock needs to do. It needs to beat expectations to go up. Meeting expectations isn't really the thing here. If you look at student loan originations, they were glorious in the good old days before Papa Biden decided to sort of suspend moratorium student loans for whatever reasons. And by the way, I think student loan debt is a scandal, but I don't think forgiveness is the solution. I think you need to go to the source that's causing the problem, which are colleges charging far too much, and you've got far too much wealth and delivering far too little. But that's just my view on it. So we've been in this period here where there is almost zero student loan origination. That's going to come back. And they already guided that it's going to come back, but they're guiding on a very, very, very low end. So even if that only comes back into sort of the 2022 levels or so, it will in itself cause a massive beat against analysts' expectations. So there's some really easy growth here for SoFi to be picked up from the student loan business. Now, this is something else investors are going to love, and I want to give a huge shout out here to this Twitter account, Data Driven Investing. He does an amazing job. Give him a follow. And he walks through this very, very nicely. I thought I'd explain it to you. SoFi is, from a dumbass analyst point of view, going to pay $4 billion of debt. And you're thinking, they got debt? Well, no, not really, but the way the market looks at this is a little bit odd. So at the moment, SoFi has about $4 billion in sort of lending facilities, and that's credit that they were getting from other banks, and they're using that money to essentially fund loans that they're handing out. And they are going to be paying that off, in a sense. So by hitting their capital ratios, The loan book will not grow as fast, but the deposits will keep growing. And the deposits will then offset the need for these credit facilities. And therefore, their loans, Sofi's loans that they're handing out to people, will be fully funded by own capital and by own deposits. And the way the market looks at this is that Sofi is paying off $4 billion in debt. And a lot of people look at stocks for like 30 seconds. They look at, is it profitable? How much debt have they got? That's the first thing that they look at. Then they might look at margins. So if it's not profitable, they might disregard it. Sofi will be profitable. And if they've got a lot of debt, they might also go, that looks dodgy, weird. I don't care. Let's move on to Coca-Cola, the stock, not the beverage. And then
I think over here he's talking about liability, right? When you are depositing into the bank, that's a liability, right? Your money is a liability to them because the bank has to pay you back that money. So, that $4 billion, yes, it's going to be a liability on the book of Sofi. And they're saying that they're going to use some of the funds to pay that loan off. I'm not quite understanding that. But if you look at the balance sheet here, Cost Enterprise right there. So I think I showed you guys this before. Now currently inside ownership is only 4% of the company there. But if you look at the gross profit margin right there versus the net income, it's not comparing to GameStop whatsoever, right? GameStop is a lot better. Now I get it, because Sofi has a top line revenue growth of 40% a year. That is, to me, is that sustainable? Like year over year, 40%, year over year, 40%. I don't know. I can't predict that, right? But the trend is going for Sofi for the top line revenue. But still, with the top line revenue increasing by 40%, it still doesn't compare to GameStop decreasing by 10%. Okay, because again, GameStop make close to $6 billion a year. This year might be a little bit less. Like maybe $5.7 billion, but still a lot higher than this. And gross profit, it's close to that, $1.3 billion. Hold on, let me just look at it real quick. Oh, I don't have it. Man, I should know this by heart, but I don't. It's a lot of number to go by. Okay, so let's look at it real quick right here. So yeah, gross profit, even though there's $1 billion, $5.7 billion in revenue, we only get to keep the gross profit of less than what Sofi could make there, because they have no overhead. I'm sure the profit margin for them is a lot higher, you see. But still though, they're unprofitable at this moment. So I don't know, the industry is so hard to compare the two company, but as far as like, okay, how much money coming in, how much money they get to keep after that, the net is what is more important, right? So currently Sofi actually lose money in the net income bucket, so to speak. So if you were to look at the balance sheets right here, yes, shareholder equity is good at the moment. But if you were to subtract the goodwill from the shareholder equity here, you would get around $3 billion instead of $5 billion. Why would I do that? Well, again, this is intangible asset, so you might not be able to get it at $2 billion worth of that. So, and if the market cap right here get to be lower than $2 billion, it's going to be impaired. But on top of that, you have a lot of share outstanding here. So, can retail actually move this up? No, I don't think so. They allow it to run. That's why it's running. Perhaps, again, it's to draw volume away from GameStop, obviously, because GameStop is going to, I think, do better in this instance for the next quarter or fourth quarter, right?
Yes, it's Charlie Munger's sidekick. So this is a good thing, and therefore it's going to improve valuations. And you can look at this in various ways, but a lot of people look at enterprise value, which is essentially market cap plus debt, and then minus cash. So the 4 billion in debt that disappears is going to improve multiples. So say here, and he runs through an example, SoFi's market cap is about 9 billion right now as I'm recording this. Their debt is 6 billion, cash is 2.8, so the enterprise value is about 12.5 billion. And let's assume here that they're just going to pay off the 4 billion, nothing else changes. It means the multiple almost halves. So this EV EBITDA multiple, which a lot of people look at, essentially looks almost twice as shiny as it does right now. And I know this is kind of technical and a little bit accountancy, but it is actually important, and that's one of the reasons SoFi also wanted to become a bank, so they could take in deposits and they could look much better there.
So enterprise value, I think this is what he's talking about right here. So currently it's not as shiny because it's not even there yet. But if you look to compare to GameStop enterprise value, wow, we're kind of like, I don't know. I don't like this number for GameStop here. Again, hey, I'm just looking at this. But again, if you look at the enterprise, it's enterprise. Sorry. What is the enterprise here? Boom. So enterprise value is that formula that he looks at. So market cap plus total debt, right? Market cap plus total debt. So, oh, and then minus cash. So right now it's 4.5 billion. Wow. Enterprise value for SoFi is 12 billion, as he was saying there. So with that enterprise value, SoFi has more value in that sense. But again, I mean, with that much valuation on enterprise asset, 3 times that is of GameStop, they're still losing money in a sense, right? $300 million in the last 12 months. Not to say that they won't improve here, but I'm saying that, at the current environment, when lending is not going to be like everybody is restricting their money here. Banks are not lending out money anymore. And I mean, there's a looming deflationary action here that is going to again, this is my opinion here. I'm not saying that it's going to happen tomorrow here, but I think the demand is not there. The real demand on the global scale. You've heard of China recessions, and even European is kind of coming to a squeaking halt here, right? The euro dollar exchange is kind of like wacky, so that usually that's indication of recessions coming. And also the bond, the 10-year treasury bond is dropping like crazy, meaning that the rate for 10 years went down pretty substantially. I mean, 1% is a lot to drop. But anyway, So that's what I'm saying, is the banking sector might not be a good buy at the moment. So okay, so
than previously. Now, analysts, the Wall Street Muppets out there, are expecting in the last quarter of 2023 30% growth, and after that, for some reason, they think SoFi is basically not going to grow anymore. Somewhere between 1 and 6% is the growth, which is just weird, because look at revenue growth over time. It was at one point 80% pre-student loan kneecapping, and then it sort of slid into the 20 to 30% excluding any student loan growth. So we would expect that to hover at least around the 20 to 30%, maybe even go a little higher with the student loans. So again, very, very easy. It should be very, very easy to beat these estimates. So this here is forecasts, whereas this is what actually has been happening. So
I think in that point to the student loan, because SoFi has been, massively kind of lopsided on the money from student loan. I think he showed on the graph earlier right here, student loan. So back in 2019, the revenue that comes from student loan was into the $2 billion. Right now it's less than $500 million right there, right? And to me, the student loan aspect of things is that people might become default, because again, with the economies, when banks are not lending out money, that's not stimulating the economy whatsoever. And usually when that happens, companies tend to cut down on workforce, right? And so they might become default, and SoFi might even losing those those billions of dollars instead of getting to recoup it back, right? Because of the delinquencies and, default and all that stuff, or delay in making student loan more, it's more of a burden to the people. But I think, if there's a federal law out there, I don't know who make it a law, but, you cannot file for bankruptcy for the student loan debt. So that debt's going to follow you no matter what. But you could file for bankruptcy if you make terrible business decision, right? The famous person that filed for bankruptcy for like seven times was Trump. And he's still, he's able to. But if the student couldn't make the payment to eat or to live or whatever, then it's on the student. So I know, the ramification is graves for some people who have student loan right now. Again, my point is that, because the economy is not going to do well in the future, students are going to struggle paying back those loans. Maybe the initial, spike in payments coming in, they might be able to appreciate from that particular quarter. But the next coming quarters, I don't think it's going to give them that big of a boost, but might give them grief later on because of the default, right? So that's my point of view of SoFi. And then I think I was watching another guy. I think I showed you guys that one before. Hold on. Let me kind of search for that real quick. In the meantime, I want you to listen to him a little bit more.
At $45. So, and this is by summer 2026. So he has a massive $100 million worth of incentives to 4x the stock price in the next 30 months. That doesn't mean he's going to pull it off, but he's certainly got the incentive to do it. So what he's actually getting paid isn't all that much. And bear in mind, he's been buying SoFi stock at these prices as well. So really, this guy is really tying his compensation to...
Who who else is tying the compensation? Like, not getting paid as much. So, of course, these are the plus, right? I'm sure, the CEO for Sofi has done amazing for the company. I get it. But for some reason, GameStop, when you have a CEO that doesn't get any compensation whatsoever, right, and buying his own stock as well. Now, this particular CEO does buy his own stock as well using his own money, but he get paid, to be the CEO of Sofi. I think he said $300,000 a year. I think that's what he getting paid, shares and all that stuff. But anyway, my point is that GameStop has exceeded expectation time and again. But guess what? This particular person doesn't like GameStop whatsoever, right? He thinks that it's meme stocks and all that stuff. If you watch his live stream from time to time, people chime in and kind of like type in GameStop, cover GameStop, and then he's like, I'm not going to touch it or whatever. That's on you if you want to invest in a highly risky stock, right? But then, when he presents this type of data, I'm like, Ryan Cohen is already, a CEO that doesn't take compensation and using that to promote it to his audience. So, okay, I found this video right here. So let's listen in. Now, this gentleman here, obviously, is we know who this is if you watch Marantz, and, he's been pumping, other stock as well. I show his video before too. But in this instance, though, he was saying right here. Now, I disagree full-heartedly in what he's saying here about the fear and greed index here. So let's listen in and
I'm sure you already realized the market is closed, and right here the fear and greed index is at 77, so it is going to want to propel the market higher. So this whole week is going to be a technical driven week. So that might be true, but usually when there is an extreme fear, you want to do the opposite. So yes, people are enthusiastic about the market tomorrow and all that stuff. It might have a volume surge here because of the fear, but eventually you're going to want to sell off that fear, meaning or sell, at the top, because that's usually the opposite will happen. Because when people are greedy, what do? You don't buy. You wait until people are fearful. That's the cornerstone of what Warren Buffett was saying. Be greedy when others are fearful. Be fearful when other people are greedy. And this guy is pushing a sentiment that is the opposite of what you should be doing, in my opinion. Okay, in my opinion. So you should be fearful when people are extremely greedy about any stock. Now, I'm sure this is about the whole market. See market momentum right here. So it's not about Sofi here. So that might be coming up here too, if you know. And so his line of thinking is that, Sofi is going to go up because of the tech stock, because of the extreme greed. No. That's usually when you want to be fearful here, based on Warren Buffett anyway, in my opinion. I gotta, I'll read that comment later. But, yeah, so that's what caught my eye. And of course, he was quoting, I think CNBC. Hold on, not quoting. I think he shows a clips of CNBC saying this here. Okay, let's listen. I just wanted to play for you. It's only a minute or so, but it does point out on how this flexibility is really going to help a lot of stocks that offer kind of things like this, one of which is Sofi. So stay tuned.
for today's Tech Check with a look at what's in store for the payment space in 2024 and specifically with that buy now, pay later trend.
So I'm listening to, because listen to the items that they're saying, and it's not necessarily a good thing. So let's listen in. And again, note the items that she was listing.
Yeah, Dom. So that's been one of the big payment trends to watch in the new year. You've got buy now, pay later, also mobile, direct bank payments, and then, of course, AI. Everybody's talking about it. Buy now, pay later, though, we'll start with that. It has seen the biggest transformation by far of the group I mentioned there. According to Adobe, it saw more than 40% pop over Thanksgiving weekend. Overall, it was up about 15% this year. These installment payments, they used to be for big ticket items like a Peloton or a couch, for example. But as consumers start to feel a bite of higher interest rates, some of these interest-free options are becoming everyday spending tools. Some of the top categories this year for buy now, pay later: groceries, toys, and cosmetics.
So those items are essential. Okay, now cosmetic, obviously. But for women, it's very essential for women, okay? And women usually, need those cosmetic, right? Items to go to work and all that stuff. And I think it's unfair, but whatever. It's just how it is. So groceries, toys. Now, toys, obviously, of course, it's a Christmas season and all that stuff. The quarter is going to be, people just buying toys. But groceries, though, I mean, people have to go to the extent of buy now, pay later on grocery. That's not a good thing. That means people can't afford to live, can't afford to buy the essential stuff. Now I get it, toys and all that stuff. I think it's due to the holiday season. That's why it spiked up. It has nothing to do with the people spending more on those things. But again, buy now, pays later is indicative of you are overextending yourself because you don't have the money to buy groceries, you don't have the money to buy toys, you don't have the money to buy cosmetic. Now that's why you have to opt in to those quote unquote buy now, pay later type of platform. And again, this is a looming threat to the economy, because eventually, how long can you overextend yourself before you have to cut down on those essential? And when those buy now, pay later platform, yes, they could make money right now, but what if they couldn't pay later? Have these people ever thought of that? That, hey, grocery, if you have to use those services for grocery, it's not a good thing, because you might not even have the pay later part. They have to buy now because they have to survive on food and stuff. Come on. Again, this type of sentiment is not a good sentiment to have. And the fact that he's pumping this, and of course CNBC is notorious for misleading people to think that this type of platform is going to do well in this environment. Again, tomorrow it might spike up just to get people in and be excited about the market here. So, hey, maybe those money is still around to I don't know. Again, I have a pretty contrary belief here, or idea about the market. I tend to feel a bit kind of like skeptical when these type of platform push something like this, right? Maybe because I'm investing in Gamestop here, I'm becoming more cynical, so I need to become a little bit less cynical. But yet still be careful about, people telling you all sorts of things about the market and all that stuff. And whether they're coming from a place of data driven or not. So I hope that makes sense. All right, guys.
Affirm has been the main beneficiary here. It's up more than 400% this year. Square and PayPal, as well as Apple and the card companies, also compete in this space with their own offerings. And then you've got mobile shopping, another trend that really took off this year, up 14% or so in the holiday season. It hit a new record, according to Adobe. Smartphone shopping made up more than half of all holiday sales for the first time during this holiday shopping season. Shopify and Amazon, they could be key winners for this trend. And then you've got direct bank payments. That really gained momentum, linking directly to your checking account. It's been a win for merchants. You're increasingly seeing utility providers, especially, offering discounts for consumers that opt in. It's a way to also limit credit card
So yeah, pretty cool stuff.
So that point might be, good for Sofi. But again, if people don't have money to spend, it doesn't matter if they could link directly towards their bank account. Again, yeah, it's unless they're another stimulus check coming in to stimulate the economy. I don't see how it's going to do. Consumer has been crushed, so to speak. And again, those three items that you mentioned is not a good thing to have to use this type of service to do that. Again, grocery, toys, and cosmetic. The three essentials here, in my opinion. Okay, so that's that. So yeah, those type of things will come to your psyche. Now, in my opinion, again, I am preparing for the worst here. Okay, so in the next 6 months, I feel like there's something big's happening here in the stock market. So what I'm preparing for is a drop in the S&P 500. Okay, and when it drops, it's kind of like violence. Now, whether it's a soft landing or whatever landing it's going to happen, I think it's going to happen, right? And when that happens, again, the panic will set and people will start to sell like crazy, including GameStop. And the price of GameStop might fall to that level that people may not be prepared for. And yeah. Of course, the diehard, investor out there like you and I will know what to do. But people who just jump in might not be prepared for the price action to be that low. It might drop down to 91% more. I'm not saying that it will, and it might not go down that far. But again, when the panic sets in, people will sell. Just like back in coronavirus time, right? People, thought that the world's gonna end. Bitcoin dropped down to $3,000 a coin in a split second, and then 1 week later, it's bring back up because of that price movement. And so the key is to not panic, right? Let's say you want to sell now and buy later. That's not a good idea either, because again, I might be wrong. Instead of, it comes down, you might not even able to catch it because it might just be, pre-market or aftermarket, all that stuff. So again, anything could happen. That's why I'm preparing for the worst and hope for the best type thing. And I'm preparing for the price action to go down, like even if it's $10, but if you've been accumulating like crazy, you wouldn't care to see the discount, just look at it as a discount, right? Okay, if you want it to be low at this price point, let's get some more shares, right? So that's just my attitude here. Let's see. Yeah, that would be awesome. $9 a share. Yeah, those type of thing again. Anything could happen when the S&P 500 went down, during the dot-com bubble. Think about it. Amazon was doing well. The metric was like, there's a lot more signed up. There's a lot of more memberships that happened. And, the balance sheet was doing well. It wasn't losing as much money. as it used to be, but the balance sheet was stable at the time when, the dot-com bubble burst. Amazon was trading at $1 a share, right? And so just know that those things will happen to a good company like GameStop as well. But again, I mean, there are people who are calling for an all-time high for the S&P 500. So that could happen too. I mean, I'm not saying that it won't happen, but as far as the double top here, I'm sure traders are looking for that mark to hit. So you might be faked out here, a little peaked and then just drop straight out of, like, this type of thing happens here. So again, now they're calling for, like, the soft landing would be around this low right there, soft landing, people. But if you were to look at, this is a Corona, right? No, this is Corona, sorry. This drop right here was a Corona, then they print the money, and of course another drop right here as well, and then they keep printing the money too. So again, these type of thing, don't take it lightly. And of course the small caps out there, just like GameStop too, is usually is going to be the it hits a lot harder when you're small cap. And on top of that, with the negative sentiment of GameStop, it might bring the price down to that point where it's unbelievable to us, because we follow the balance sheets and we know what the company is doing, how the company is performing, based on Ryan Cohen as the CEO. Which brings me to Ryan Cohen's centric segment of the live stream. Anyway, alright, so it only take me 50 minutes to ramble on about Sofi, huh? So yeah. I know. Yeah, of course, it's a blessing to be able to look at this company and kind of see how it actually is, and not how the media is portraying it to be. But we're living in a world that is reactionary to the news, right? And keep in mind too, because the trading, bots out there, because it's based on the computer algorithm here, it's not really human trading all of this. Price action, it's all about news. And if the negative sentiment keep popping up, those price action might not even, happen for a while, until, the company is substantially, making like money hand over fist type thing, that, the sentiment will be flipped. The script will be flipped, so to speak. And, this news channel, right, this news, talking head right here, CNBC, I think I use CNBC a lot because, again, no, that's CBDC, CNBC, because it's a news that, kind of flip-flop based on what they feel about a certain company, or, whoever pays them more to promote their stock, or, whatnot. So, again, if more and more people come to GameStop because of Ryan Cohen, because of the style of leadership, these type of people will flip their script eventually. Just not currently, because they want to pump you other stuff that is overvalued already, so that you lose money there. Meanwhile, while they're poo-poo GameStop, they're scooping it up, so to speak, right? Buying shares and, accumulating it that way, so that when you remember how they so that when GameStop is doing better and nobody really pay attention, let's say 5 years later, they'll be like, oh, look, GameStop make $10 billion today. I don't know, I'm over exaggerating, but you know what I'm talking about here. The negative sentiment is actually a good thing for long-term investor when it comes to this company. Okay. Again, that's why I steer people into reading the balance sheet. Learn how to read it. If you don't know how to read it, learn how to read it. You're going to be infinitely a better investor. Yeah, thank you, Lena. But anyway, so let's scroll down. Ryan Cohen, and and this is the man behind the curtain here. But I think I admire him so much. The reason why I admire him so much, and we'll go through it, right? Of course, I touch on many a time about the leadership style of Ryan Cohen, and his upbringings and all that stuff. How he was able to turn Chewy into, a success, to say the least. But of course, the media is just poo-pooing that too, saying that he's not successful. He's never demonstrated anything, with the exception of Chewy, that he got lucky with Chewy. Okay, he got lucky with Chewy, without giving him the credit of building the brand that was Chewy. The reason why it becomes the household name is because of him and the co-founder, obviously, and the people that worked their heart out to make Chewy the way that it is. And he benefited from it immensely because of the billions of dollars that he was able to make from that growth of the company. And, he wouldn't be able to do it. And he wrote it in an article. I think I showed you that one already. But let me try to paraphrase it. He said the pivotal moment of Chewy was when Larry Chain gave him $15 million. And that's what gave rise to, his, the growth of Chewy at the time, because it went from, $250,000, right, of sale, and then having to grow it to whatever, beating the Amazon sale in I think 4 or 5 years after that, right? So to do that, it's not luck here. Like, people seem to think that, oh, it's lucky and all that stuff. No. This guy is working his ass off to get that, and that's what I admire about him. Yes, I mean, billions of dollars is rewarded to him because of the years of struggle that people don't get to see. All they get to see is what the media presented at the time when Ryan Cohen was the former CEO of Chewy, and they tried to promote Chewy to the public in order for them to buy it at a higher valuation than they got it before. See what I mean? So again, Ryan Cohen served them the purpose of promoting Chewy to the public, but now Ryan Cohen doesn't serve them anymore. Therefore, he is the public enemy number one in their eyes, right? Because again, he's in GameStop, and GameStop is largely retail owned, right? So the script can't compute with these people, the media. Yeah. No, that's a catalyst. What do you mean, Leno? The catalyst for what? So let's go through his tweet right here. I always give a kick on like, I think I used this one for my live stream here. So what does that signify to you? I think he's trying to communicate that he's going to be here for a long term, like for a long, long time. And, and it's kind of solidified on that front there. Good confirmation that he's not going to ever sell GameStop at this moment, right? He's going to build it to what he's going to become an old man right there, right? And he's going to dedicate his time and effort into growing this company for shareholders, whoever want to buy these shares. And I'm sure rich people out there, they only care about making money. And if this guy is able to deliver, time and time again, they're going to flock in eventually. This man is valuable to them. Okay. It's much more, valuable than anything, because people like this is rare and on earth. I'm telling you, because not only that he has principle, guided by principle, that's his own word too, that he is picking a company here in order to hopefully build something better, right, over time, right? That that he's not just sitting on the board to just get shares like Adam Aaron, for example, take money out of the public hand instead of creating a valuable company in order to make people money, right? So, or people, I'm talking about people, like in order to make people who believe in him, money, like the shareholder angle here, right? And with that $15 million, he was appreciative of that. And that's why I think that sentiment is prevalent in this instant as well. Even though, we can't communicate with him. Obviously, we don't have the access of the VC out there to have, direct access to him and speaking to him directly. But I think he takes shareholder very seriously, the value of shareholder. Whoever believes in him will win towards the end. Now again, the media is trying to give you this sense of urgency. It's like, 3 years, like this guy doesn't do anything in 3 years. It's fundamentally, he's fundamentally a failure, I'm quoting the Yahoo guy, I think Brian Susie or whatever, right? Really? So you only evaluate people based on 3 years of doing anything at all? It's like, really? 3 years. That's all you need to tell if people are successful or not. But at the same time, you bring like Charlie Mungers up, you bring up people like Warren Buffett up on the pedestal, right? Why? Because he's been successful for 40 years. So why don't you give Ryan Cohen a little bit more time, And so again, the media is always try to create that urgency. It's like, buy now, pay later, or, you're not going to get it ever again in your whole life. So buy now. So that mentality needs to like, what are you, 5? Like, can't you wait for the success that is to come in 10 years? So, but anyway, just my rant here a little bit. And of course, he bring up Warren Buffett a lot, and I think he's very familiar with the long-term way of thinking here. That's what I admire about him too. Of course, he admired his father, talked about him quite often on his chat, or on here anyway. And then he said not for long. I think this is when he become the CEO, or set out to become the CEO of GameStop, right? So we know all that. And this is also too, and I think this is why he choose to go to the path of what, compensation, so to speak, right? this man is setting an example for the whole world to look up to him. Okay, well, the whole world, the people that resonate with him, and I'm sure if you invest in this company, you probably see this as well. That he sees that those CEOs out there that are managing the big companies out there, they don't really care about the working class, right? And on top of that, they get to keep 300 times more than the average worker here, right? Why? How is that possible? Well, number one, they cater to Wall Street because people who invest in that company could take money out of that company anytime. So, but in order to do that, you have to screw over some people, right? And usually it's the shareholder, the class 1 shareholder. And many people don't really know this, that some company have different class of stock. One example that I know of is AMC, right? AMC have a preferred equity units, right? Apes, and the tips and tricks out there that they could they could use to even oust the current shareholder. And we see it happened right in front of our face. Apes was the thing that they used to, it's called poison pill, right? Even though, shareholder equity or shareholder is trying to invest in those type of company to try to, infuse cash into the company. But when you buy into the company, you own part of that company. So you do have votes. You do have rights as a shareholder, right? And this is why APE was introduced in order to oust retail as the majority shareholder. It's not a good thing for the people who hold that stock because you've been diluted, right? So when you used to own 90% of the company, maybe at one point you were, but now you only own 30%. So the power structure has been shifted, and this is why Adam Aron could do whatever he needs to do, or he wants to do, sell it out, more and more diluted every single time. So and they were able to do that because they have this clause, right? That some shares are more powerful than other, and usually the preferred equity unit is more powerful than the common share, class A common share holder. But guess what? GME doesn't have that. GME has only one class stock, and that's the stock that Ryan Cohen bought, that you and I bought, any board of director. Now that could change. I'm not saying it won't change in the future, because the structure has to be enticing to these people, the big institutional owner out there. But again, I don't think Ryan Cohen is there to appease them, so to speak. He's there to deliver the most value for GME, and shareholder in general. So again, and this type of thing kind of give me the idea that he has a good pulse here on what is going on in America and the world at large. And of course, I'm not saying it's all bad either, but it's egregiously kind of lopsided, so to speak, right? And then this is a good kind of meme too, right? So in this particular one, this is how I get from it, right? So he's saying right here, due to the cutback, we're going to have to fire Dave. So Dave is the representation of working class. You and I, go day in and day out, right? But these people who are, the HR manager out there, just sitting there, discussing with the marketing manager, and then you have a logistic manager there, and then you have a security manager, and then you have an IT manager, project manager, PR manager, every single one, and an internal supervisor right here, all the management class out here, just standing there doing nothing. But yet, when the cut's coming, you cut the working class, right? And I think this is the reason why he just like, what is it? Matthew Furlong, right? Trying to eliminate all of that middle management there and try to deliver as much value to the working class as much as possible, right? Of course, when it makes sense. I know like people saying, well, if that's the case, why did he, cut back on the 401k? I think there's there might be an angle here that we don't understand, that I don't completely understand either. But I think eventually it's gonna come back to that point. But currently we just can't do that at the moment to give the benefits. But again, like it's not like they're cutting everybody's 401k here. Okay? Like I keep forgetting. I need to find that memo so that I could read a lot more about the 401k cuts and all that stuff. But I think he's cutting all of this middle management that just there to waste resources, right? Meanwhile, kind of put pressure on the working class here in order to, keep more for themselves here. Not to say that they're not valuable to have at one point in the whole thing here. I think we're not big enough yet as a company. It's multi-billion dollars cell industry here. But what I'm saying is that eventually we're gonna have to bring those mid-management back. But I think what Ryan Cohen is trying to achieve is to grow slowly towards that expansion, so to speak, right? And I think too, this is one of the reasons why we were able to cut down so much, is because we don't have to deal with all of these mid-management people there. Okay, so show mom's love. Aw. There's nothing more special than GameStop gift card for Mother's Day. Of course, he was promoting that. So just he's I feel like he's down to earth guy, right? That is there. And of course he's tweeting this out too: give me liberty, forgive me death, or give me death unless there is a virus with a 99% recovery rate, in which case strip me and of my freedom, my job, my constitutional rights, and put me under a house arrest. So yeah, it's just go to show you that he's understand that the world at large here is being manipulated when it comes to what happened in Corona at that time. And I don't know, honestly, I don't know if it's orchestrated, but it seems so ridiculous that the death rate wasn't that much. Yes, there are people who died from it, and it's very sad. I know somebody who I worked with who lost their family member to Corona. I get it, it's sad, but as far as the rate of dying, it's like slightly worse than the regular cold, so to speak, right? And also too, the fact that you have to mandate the vaccine, that was another thing that kind of like frustrating to me too. And people who weren't vaccinated was demonized. It's like, okay, so if you don't vaccinate, you put yourself at risk, but if you vaccinate, you should be fine. So, people could lose their job and all that stuff. And it's ridiculous. And we all know now that something else was, afoot there. But anyway, I'll get off of that. Let's go back to Ryan Cohen here. Okay. Sorry, let me grab some water real quick. How's everybody doing? Hey guys, whoever just joined. Merry Christmas to everybody. But anyway, thank you for hanging out with me here. I'm just like reflecting on the year, and it's Christmas and I'm bored. Usually I'm with my mom right here. She's watching her shows. So it's always nice to be with family. But there are times when it's kind of getting bored. I get bored too. So it's nice to be able to spend some time with you guys here on live. Very appreciative. Okay, so of course he knows about the inflations and what happened here. Don't give a fig. This sentiment is kind of like prominence here, because there's really no reason to fight for anything anymore. These two parties are the same party. You're not really, like there's no distinction here at all. Sorry. I have to clear out my throat a little bit. Okay, so corporate America is a wolf of liberal clothing. In liberal clothing. See, he has a sense that corporate America is there to take and take and take. Companies out there who are trying to do the right things can't survive because of the network of people that are, in that group. And it's pretty difficult when you don't have the funding behind it. And this is why debt is so important to pay off, when it makes sense for the company. If you are heavily in debt, you are a slave to, quote unquote, corporate America, quote unquote. The bankers out there, the people that lend you those money, has a say on what you could do with your company. Even though you spend your whole life building a company from the ground up, you have no say because they lend you that money, just look at AMC. Think about it. Like I said, I've said this before. Even if Adam Aaron wants to save the company, he can't. Even if Adam Aaron wants to save retail, he cannot because of that debt. So just think about that. And people who still, believe in AMC, I'm sure there's a lot of people out there still who believes that it's going to be the same way. Just like, AMC Bigum has a bigger platform than I could ever dream of, right? It's pushing that narrative until this day, after the dilutions and 3 million shares being sold off market, and still defending the dilution. And more is coming. Don't worry, more is coming. But anyway, this is not about AMC. Let's go back to Ryan Cohen. So this is a reference for getting high, right? At 420, I think that's what it means. It's like he's saying that corporate America is high all the time. Every day is getting high day type thing. America is littered with managers making millions in risk-free compensation. Yeah, it's true, right? Those managers Yes, they are important. I'm not saying some manager are very good at what they do. I get it. But if you're not rolling up your sleeve to experience what your worker are going through, and managing, a lot of people, I get it, very stressful sometimes. I'm not knocking that. I've never been a manager in my life, but I've known a couple that bust their ass off in order to make the worker at least life a little bit easier. But those type of manager overextend themselves because, again, they have to answer to somebody higher than them. And if the pressure that from the higher up, the corporate, the CEO out there, didn't want you to care too much about your worker, usually working class gets cut out of the equation, just like this picture portray, right? Any sort of cuts at all comes down to the people at the bottom, at the very bottom. And he seems to know that. And then this is, I think he refers to Bed Bath & Beyond at this time, right here. Again, and this is where, people in the media seems to kind of bring it up all the time. Bed Bath & Beyond. He's a failure because he invested in Bed Bath & Beyond and dump on retail, right? It's ridiculous. And, to me, every time you bring that up, I thought you go into the market to make money. He did make money, I'm sure if it's not Ryan Cohen, Yahoo Finance probably praise people like this, right? I don't remember who. I think Bill Ackman or something. Somebody make a whole bunch of billions of dollars, through a private deal or whatever. I think CNBC, parade them and say, oh, what can you do to be so successful, right? But when Ryan Cohen, make the trade, make the money on the trade on Bed Bath & Beyond, he's a villain, Ridiculous. Okay, and then there you go, and then he did the Teddy thing, and this is where Bed Bath & Beyond people, kind of like, oh, look, it's blah, blah, blah. For those of you who don't know what Teddy is, it's just a children book, right? And of course he trademarked it, as a company that, a supervisor, and it's not easy. I know, you have a lot of responsibility, but those responsibilities sometimes, you can't care about. I'm not talking about people who, managers who cares about their worker here. I'm talking about the people that are there, not putting the work in and expect working people to do most of the work when there are cuts happening, right? And again, when today's society, in today's environment here, you heard about job cuts, right? 10,000 jobs being cut out of the mortgage industry. And usually that's what happens. The CEO up there, they're like, hey, we're not going to be able to make more money here. So therefore, let's cut, working class out. Meanwhile, they have their own bonuses, right? Look at the GM CEO out there, right? Remember the GM CEO? She gave herself 20% raise, but then, don't want to give the assembly worker any raise at all, right? And, they have to go through strike in order to get that raise. It's ridiculous, right? Anyway, back to Ryan Cohen. I always go off tangent. Man, it's been okay. Let's go for another 40 minutes here. I don't know how long I'm gonna stay here, honestly, but I'm just appreciative of you guys sticking around. So this one is a famous. For those of you who doesn't know, this is car icon. He was notorious or famous for activist investor. I think he turned some airline company around, or kind of carved it out so that he has more asset. You have to watch him. A documentary about it, but he's a very famous investor, and of course Ryan Cohen looked up to him as well. I think he's famously had a short position on GME during the run, so I don't know if he already closed the position or not, but who knows, right? I don't know what was the meeting all about. Maybe he is trying to kind of ask for advice, what to do with GameStop and all that stuff, or other investment. Try to learn from him as much as possible. So yeah, I mean, he knows a lot of smart people, so of course he probably try to pick the brain of car icon there. He's talking about the low interest rate can prove to be like easy sex, but tempting but possibly fatal. So of course, like, low interest rate is very, very attractive to people, right? Especially, high growth stocks out there that really doesn't have any way of making profit, but they just borrow until they can't borrow anymore. It's just like AMC, right? It's like low interest rate. They just keep borrowing billions of dollars later. Now when the rate is high, they don't know how to survive except to take money from the public, right? So there you go. That's what happened when you have interest rate low, encouraging people to borrow, and then when they can't pay it, they're like, oh, file for bankruptcy. So who would be who's lose from that? Who's the thing that losing? What am I saying? What the hell? Who lost from that transaction? When you file for bankruptcy and you own a stock, usually Class A common stock, like you and I, are the one that lose in the end. So again, it's paramount that we don't have any debt, and I think that's why he made the decision to pay off debt and just operate based on what we could survive off of the sales of the items itself. We are in a retail business here. Of course, we want to see the real growth from the sales number and not the financial shenanigans that happens. Of course, I think he's aware of the interest rate as well, right? That's why he put it in the marketable. That's why he made the decision to put it into the marketable security in order to accrue that interest rate. So instead of paying other people interest rate, we get to keep the interest rate because we have the money to put it away. So again, like, this is a good leadership could see that from miles away, right? I think Warren Buffett probably do that same thing too. Like, this is why he cashed out so much of his stock and went into cash. And when you have cash and put it in the marketable security or treasury bonds or whatever, you get to keep, at least, yes, it's not that much. It's not sexy, like 5% or even 3%. It's not sexy, but at least you're not losing in the other, high risk stock out there. or just leaving money in the form of money, like cash, so to speak. Anyway, okay, what else? Let's see. If we print a few trillion more, it would bring inflation down. I'm sure this is sarcastic, obviously. So he knew that too. He knew that that is happening. There you go. The best time to be alive in human history is now. Okay, I mean, I agree with that. I'm sure he means it when he said that. People who work hardest usually complain the least. You see that? This is why I like him too. Wait, unless you sweat on the job, you don't know hard work, right? I have much respect for everyone working on the ground in our stores. So there you go, right? Like, people who work the hardest usually complain the least. And I see it, like, in every single instant out there. I've worked with people. I myself, I feel like I'm a hardworking person. But, yeah, usually we don't complain because, like, it's a waste of time to complain about something. And again, like, if you have management who knows this, they only value people who work the hardest. Right? So, I think that's why he's able to be successful. And again, and also too, see, this is why he doesn't do earnings call. I feel like, and it pulled the hair out of these Wall Street type. It's like, oh, why doesn't he give any guidance? Like, this is something that you would want to communicate to your shareholder. It seems like he's disrespecting, shareholder here. It's like BS, right? Like, you're trying to, well, okay. So for those people who complain a lot, right? Like the medias and all that stuff, they're not working hard at all, right? I'm not saying, again, it's just my speculation. I'm speculating here. But people like that, of course, they don't know the value of hard working, what it takes to build something like this. Okay, so they're gonna complain. They're gonna complain until they're blue in the face, and then they're like, "Oh, why are these people getting ahead?" Right? Why is Ryan Cohen able to deliver these type of number right here? And they wonder why. Like, they're all struck. Again, like, we're losing $100 million right there, but we were able to beat on earnings by 100%. And that's not a good thing. It's like, goodness. But anyway, let me go back. Alright guys, I think I'm getting hungry here. My stomach is growling. I don't know if anybody hear that. Yeah, so I hope you enjoy the live stream. I appreciate everyone who's sitting through this. There's a couple of you here. Yeah, so Jay was here earlier. I don't know if he X'd out already, but yeah, Lionel, appreciate you for joining here. Appreciate everything. Alright guys, that's all I have. I'm sure, you could go to his page here and kind of scroll down. And, he has a good, like right here. Work is sexy. Power to the player. So he's all into GameStop. And he's not gonna stop until he become this right here. So I think this is a good place to end. I wish you a Merry Christmas. Alright guys, that's all I have. Okay.